Picture this. You're deep into a costing problem and you spot some sales revenue from a byproduct. Your first thought? Awesome. Easy marks. I'll just credit this to the P&L as miscellaneous income. Seems logical, right? But what if I told you that simple move could be a trap set by the examiner?
Well, it's because this exact scenario is one of ICAI's favorite ways to check if you really understand the concepts. Getting the treatment of byproducts wrong is a super common way students lose precious marks. So let's dig in and make sure that doesn't happen to you. To make sure you never fall into that trap, we need to look at the whole picture. Today, we are going to do a deep dive into one of the most practical chapters in costing, joint products and byproducts. We're going to tackle every tricky corner and get you totally exam ready. Okay, first things first. In costing, getting the terminology right is half the battle. If you confuse the definitions, your entire problem will collapse. So let's make sure our foundation is rock solid. So what exactly are joint products? The best way to think about them is like siblings who are all equally important, right? When you refine crude oil, you don't set out to make just petrol. You know you're going to get petrol, diesel, and kerosene all at the same time from the same process. None of them is the main product. They're all significant. That's the key idea. And what about byproducts? Well, these are the little guys. They're the things that pop up incidentally while you're focused on making something else. Think about a sugar factory. The main goal is to produce sugar, but along the way you get molasses. It has some value, sure, but it's nothing compared to the sugar. It's kind of like a bonus you weren't really aiming for. Now listen up, because this next concept is absolutely crucial for your exams. It's called the split-off point. Imagine all that crude oil flowing through one giant pipe. At some point, that pipe splits into separate streams for petrol, diesel, and kerosene. That exact point of separation is the split-off point. And here's why it matters. Every single rupee spent before that point is a shared common cost. We call these joint costs. So let's just nail this down. Joint products, they have significant value, and you make them at the same time on purpose. Byproducts, they have a small value, and they just kind of happen by accident. Getting this simple difference right is the key to unlocking the whole chapter. All right, so we've got this big bucket of joint costs that we spent before the split-off point. The central problem, the whole reason this chapter exists, is figuring out how do we fairly slice up that cost pie and give a piece to each of the products that came out. And you might be wondering, why even bother? Well, it's incredibly important. If you don't apportion those costs correctly, you can't value your closing stock properly. You won't know how to price your products, and you'll have no idea which of your products are actually making you money. It's fundamental. Okay, let's get into our first method for splitting up that joint cost. It's the simplest one of the bunch, called the physical units method. And just like the name says, it's all about physical quantities, like weight or volume. The logic is really straightforward. If you produce 100 kilograms of product in total, and product A is 60 of those kilograms, then product A gets 60% of the joint cost. Simple. But, and this is a big but and a key exam tip, ICII loves to ask about the flaw in this method. And the flaw is huge. It completely ignores how much money each product actually brings in. A kilogram of gold dust would get the same cost as a kilogram of sand, which just doesn't make any business sense. So since the physical units method has that major weakness, we need a better way. That brings us to a more logical approach, the market value at split-off point method. This one says, hey, forget about kilos and liters. Let's use what really matters, the selling price of each product at the exact moment they become separate. And that idea leads us right into the more advanced and honestly the more important value-based methods. Pay close attention here, because these are the ones that you're almost guaranteed to see in your exam. Now, what happens if you can't actually sell your product right at the split-off point? Maybe it needs some extra polishing or packaging. In that case, we can use the product's final selling price after all that extra work is done. The steps seem easy enough, right? Find the final sales value, create a ratio, and apply it to the joint cost. But wait, listen very carefully, because here is a classic ICAI twist. The question will give you the further processing costs, trying to tempt you to deduct them. You must not. For this specific method, you use the final sales value only. You completely ignore any costs that happen after the split-off. So many marks are lost right here because students mix this up with the next method. Don't be one of them. And that brings us to the king of all methods, the one that's considered the most logical and is by far the most frequently tested. This is the net realizable value, or NRV method. Please star this, highlight this. This is very important. So how does NRV work? It's all about working backwards. We start with the final selling price, just like the last method, but then we subtract everything that was spent after the split-off point. We deduct further processing costs, we deduct selling and distribution costs, we even deduct a profit margin if the question tells us to. And the common mistake, the place where everyone gets tripped up, it's forgetting to deduct one of these items. You have to subtract all post-split-off costs to find the correct NRV. Let's look at a quick example to see this in action. Product A sells for $34,000, but it costs $4,000 to finish it. So its NRV is $30,000. Now look at product B. It sells for a much higher $52,000, but it needs a whopping $32,000 in further costs. So its NRV is only $20,000. This means our apportionment ratio isn't based on the sales value, but on the NRV ratio of 30 to 20, or 3 to 2. We use that ratio to split our joint cost of $64,500. See? The product with the higher sales value actually ended up taking a smaller piece of the joint cost. That's the logic of NRV. Phew! Okay, we've totally nailed how to apportion costs for the big-ticket joint products. Now, let's switch gears and go back to where we started, the special rules for those little guys, the byproducts. Okay, remember that trap from the very beginning? Here's the full story. How you treat the money you get from a byproduct sale depends entirely on its value. If it's a really small, insignificant amount, you've got two options. Option one is what we first talked about, treat it as miscellaneous income in your P&L. The second option, which is often preferred, is to deduct that sales value directly from the cost of production of your main product. But if the byproduct actually has considerable value, you can't just brush it aside. You have to treat it more like a mini joint product and actually give it a share of the joint cost. And here is one last trap where marks are frequently lost. If your byproduct needs some extra work before it can be sold, you absolutely must subtract those further processing and selling costs from its sales value first. You only ever use the net amount, the cash you actually get to keep, in your accounting. The examiner will give you the gross sales value, just hoping you'll use that number. You have to be sharper. Always calculate the net realization. Okay, we have covered a ton of ground. So let's pull everything together with a quick summary table. You might even want to screenshot this for your last-minute revision. Here it is, all in one place. The physical unit method is based on quantity and ignores value. Market value at split-off uses the price right at the point of separation. Market value after processing uses the final price, but, and this is key, it ignores the extra costs. And finally, NRV, the most logical one, uses that final sales price but carefully subtracts all those post-split-off costs. Know the key difference for each one, that's where you win or lose marks. So, to wrap things up, I'm going to leave you with a question to think about. Forget the formulas for a second. Which of these methods do you think gives the most fair, the most accurate picture of a product's real ability to earn money and absorb costs? Really understanding the why behind these methods, not just memorizing the how, is what separates a good answer from a great one. Think about it. All the very best for your exams.